So you've got £300,000 in your pension, you're age 65. What will that actually give you in retirement? Let's break down the numbers. I'm Lee the Pensions Guy, your guide to financial planning, pensions and smarter money decisions. Make sure you hit those buttons, give me a follow, and let's get into this. So in this video, I'll show you what income you could receive if you've got a £300,000 pension and you're looking to retire at 65. We're going to assume you're going to take your tax-free cash and we're going to compare an annuity with a drawdown. So let's start with the basics. 25% tax-free cash will give you £75,000 tax-free, and the remaining pension pot is £225,000. The tax-free cash can be used as a bit of a buffer. You could pay off some debt or home improvements, but the retirement income comes from the £225,000. So option one, a 3% escalating annuity. A 3% escalating annuity starts lower but will increase every year by 3%, helping it keep pace with inflation. So for example, a healthy 65-year-old currently, to purchase an annuity rising at 3% a year would give you roughly between £12,000 to £13,000 a year. That's guaranteed for life, increasing each year by 3%. It gives you certainty and it gives you predictability. But there's less flexibility, so you can't change your mind, and what is paid on death depends on the options you choose up front. So option number two is you can keep the money in drawdown. So instead of locking into an annuity, you keep the $225,000 invested and draw an income flexibly. A common starting point is a 4 or 5% withdrawal rate. At 4%, that would give you about $9,000 a year, and at 5%, it would give you $11,250. You can also take more in the early years and less later on, and anything left in the pot normally forms part of your estate on death. But remember, there are no guarantees. Income depends on investment performance. Even if you take too much income out at the beginning, you could run down your pot really quickly. So what works best for most people isn't one single option. It's potentially a blend. Guarantee some of your essential incomes with a secure income and keep the rest invested for flexibility, holidays, and those go-go years. Your health, your lifestyle, other income sources, and your tax position all influence what's right for you, and this is where proper financial planning makes all the difference. So if you're looking at your pension and thinking, should I lock in income or keep it invested? Drop 300k in the comments and I'll give you some pointers on what you should be doing. But you need to see the numbers modelled properly, and you need to take into account state, pension, tax, and inflation. So having a cash flow plan done is one of the most powerful tools you can use. So I'm Lee the Pensions